Good morning and welcome to this Monday, August 3rd, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, welcome to August. Can't believe we're all the way into August now. It seems like 2020 has been going on forever on the one hand, and then on the other hand, it seems like it's flying by. So I don't know, I guess it depends on how you look at things. But certainly from a market perspective, it's hard to believe we're now into our 8th month of this year. Got futures looking up to start August. That seems to be the theme. That's where we've been for the past 4 months, it seems like. Market just relentless to the upside. I'm not shocked. I still believe that many of these companies, especially many of the large cap technology companies with their tremendous earnings growth, even in the midst of this pandemic, when you throw in historically low interest rates, these earnings are valued much higher than they would have been 20 years ago when we had 10-year Treasury yield up, 5-6% or wherever we were. So I think it's going to be more of the same. I've been saying this for a while. I believe we're in a secular bull market, one that's going to take us a lot higher over the next 10 years. And I know, one of the questions I get anytime I say that is how can the market go up any more than it's gone up? Well, I think if you strip away the pandemic, you look across where we were 6 months ago, 5 months ago, the S&P 500 is below where it was. I believe the economy is going to be strong. I think it was very strong before the pandemic. I think when the pandemic is behind us, it will be very strong. And you have to keep in mind the stock market's worried about what's going to happen in earnings for the next 6 months, 12 months, couple of years. You're taking forecasts that go out a period of time, and then you're discounting those earnings back at historically low interest rates. So I think there's a lot of room to the upside. And as far as where the money comes from, you got a ton of money sitting on the sidelines, and you got a bubble in bonds. I don't care what anybody says. When you've got global interest rates anywhere from here in the US, 0.55% on the 10-year Treasury to minus. I still can't quite get my mind around the idea of giving somebody some money, letting them borrow it, and I'll pay them. This is just, it's still a little too much for me. But I think we're going to return to a period of growth. And I think when you've got people looking at equity markets around the world going higher, and they're sitting on bonds where many parts of the world they're paying to have the right to borrow money, to lend money, that makes no sense to me when you've got the stock market going higher. So I think you're going to see a lot of money rotate from bonds to equities, and I think there's a ton of it to rotate over the next few years. And that's what's going to really drive the market. If you know anything about the market, if you follow history, you know that when money rotates, it's one thing for new money coming in to drive the stock market higher. But what really drives it higher, when you go back and you look, is when Treasury yields rise. That means money is rotating out of Treasuries. Treasury prices go down. The interest rates on those Treasury bonds are fixed. So when the prices go down, the yields go up. So if you look back in the market history, when the yields are rising, especially when the yields are rising and they're under about 5-6%, that tends to coincide with huge advances in the S&P 500. So that's where I think it's coming from. Now, I got into a lot there before we even got going here, but still, I think it's really important to just understand where I think the money's coming from. And for me, I think it's going to come from the bond market and new money coming in. People are going to continue to invest. Right now, a lot of folks, individuals, still scared of the market, still read all the headlines about how this, we're going to have a second wave, and we may very well. It's a healthcare issue. The stock market doesn't care as much about it, nearly as much about it as the healthcare industry. And the healthcare industry should be thinking about it, should be worried about it. The stock market's looking past it. So, if this goes on for the next, 3-5 years, and there's no vaccine and there's no cure, then yeah, we've probably got some more issues to deal with financially. But that's not what the stock market's telling me right now. All right, we're going to get into everything here in just a minute, but I do want to point everyone, anybody who's new to Earnings Beats, over to earningsbeats.com. Love to have you sign up for our free Earnings Beats Digest newsletter. Comes out Mondays, Wednesdays, and Fridays, usually before the market opens or right around when the market opens. But it will help to maybe acclimate you to what we do at Earnings Beats. So we're looking at earnings. You know, we're probably one of the few sites that actually looks at both fundamentals and technicals and historical, seasonal. We combine it all to try to come up with the best package, best research for our members. I think if you look at our portfolio and you look at the performance that we've had since we've been tracking this, and I've been doing a strong earnings chart list now since the fourth quarter of 2013. My prior background, I was a former practicing CPA, and so fundamentals are still pretty near and dear to my heart, but they do not drive entry and exit in the stock market, not by those in the know. Those in the know are following the charts, and you're going to see it show up in the charts long before you're going to see something show up in terms of fundamental news. So it's a combination. You want to have stocks that and companies where management is executing a business plan. And that's where the strong earnings chart list comes in, because these are only companies that are beating revenue and earnings per share estimates. And when you beat your revenue estimate and you beat your earnings per share estimate, and then you raise guidance, the market believes you. Wall Street believes you. When you come in, you miss your earnings, and then I'm sorry, we missed our earnings, but we're going to raise our guidance for next quarter. Well, you just missed your earnings the last quarter. Why should I think you're going to beat next quarter or even match next quarter? So there's just that little, I don't know, it's a trust issue, I think. And we're actually beginning to track the performance of our strong earnings chart list along with all of our chart lists. And even after just the first few weeks, I'm going to start sharing this probably within the next couple weeks. But even here in the first 3 weeks that we've been tracking it, we started around mid-July, the numbers already are crazy as far as how the strong earnings chart list performs relative to the S&P 500. It's already crushing it. And it makes sense because I think folks want to get into companies that are providing, not only strong guidance, but are executing. They're actually over-delivering, under-promising, over-delivering. That's how you make money in the stock market. Not by saying how great we're going to do next quarter and then come up short and then say how great we're going to do the following quarter. The market doesn't care about that. So anyway, pretty good performance here based on how we look at things. You can feel free to join. We'd love to have you. It's a $7 30-day trial. $7 gets refunded to you in the first week or so. So literally it's a no-cost 30-day trial. But anyway, check us out. Love to have you join us. All right, let's take a look at what happened on Friday. First of all, we had some massive earnings reports coming out Thursday after the bell. So the market was, I'm sure, on pins and needles. I had no doubts whatsoever that the companies reporting were going to report solid results. As I said, going into Thursday and even last week and before when we had our earnings, we had a Q2 earnings webinar just, I don't know, maybe 2 weeks ago. Been that long ago? I think it was 2 weeks ago. But anyway, I was looking at these earnings coming up, and the one that bothered me was Google. Among the big companies that were reporting, we had Facebook reporting, Apple, Amazon, and Google all reporting Thursday after the bell. Google, I was a little concerned with. Facebook, I'll be honest, I was a little concerned with. Apple and Amazon, I had no concerns whatsoever. I figured they were going to post blowout numbers, and they did. Apple, I mean, it's just, I don't know if there's a better company out there, period. It goes up in bad stock markets. It goes up in good stock markets. It's a company that has become, it's very, it's still got a lot of growth. So you've got, those who are seeking capital appreciation want to own it. But there's also a safety element in Apple, because the iPhone, their computers, everything else, it's a staple almost now. So when the market was getting hit back earlier this year, technology held up very well. And one of the big reasons was Apple. Apple continues to deliver in any kind of market. And so they're actually favored by those who are, a little bit more risk averse. I mean, when you think about it, Apple's got a dividend yield more than the 10-year Treasury yield. Their dividend yield is probably 150% of the 10-year Treasury yield. So you get the safety of their dividend. You think their dividend is going to go away anytime soon? I mean, look at their earnings. Their dividend, I think, is safe, probably going to get raised. And they, continue to deliver on top and bottom line. But anyway, that was the news going into Friday was, these earnings reports. We saw a big gap up on Friday. Then the market kind of pulled back and you're wondering, okay, is this it? Has everything been built in? And then the last 2 hours, we saw another big rally in the market that tells me this isn't over. Now, could we consolidate? It's August, it's September, right around the corner. You got these 2 summer months that historically are not great months. I would say, yes, we could certainly consolidate. I wouldn't bet against this market, though. I would not short. That's my opinion. But I believe we're in a secular bull market, and I am only thinking about long positions. But if you look across the major indices here, you got the Dow Jones up 114 on Friday, the S&P up 25, NASDAQ up 157, easily the outperformer on the day, once again, threatening another breakout above the double top we already saw in July. We'll see whether or not we get that. We got strong futures this morning. Last time I looked, I think NASDAQ was looking at opening up another 100. So we're getting pretty close again to that 11,000 level. We haven't seen a close above it. Could this be the day or the week? Very possible. Mid caps, small caps underperformed last week. That's been a theme really since March, April. We get a little bit of outperformance every once in a while, but for the most part, on a relative basis, this is a weak area of the market. Now, it's trending higher. Nothing wrong with it. But if you're trying to beat the S&P 500, you're going to have a much better chance, I think, sticking with NASDAQ stocks than trying to time the relative bottom in mid caps and small caps. All right, as far as sectors go, technology strong, as you might imagine, with those earnings reports coming out, especially with Apple. Technology up 2.5%, easily the leader on Friday. Communication services with internet stocks doing well, especially with the reaction in Facebook. Communication services had a great day. Discretionary stocks also up about 0.5%. And then from there, it wasn't that great. So you had 3 really aggressive groups leading the advance. And that's the reason why we saw such outperformance by the NASDAQ. On the bottom of the sector leaderboard, healthcare lost over 0.5%. Energy lost almost 0.5%. Big difference, though, in their charts. So healthcare broke out. We've been waiting for that breakout above about 104. We got it. We ran up to about 107. We pulled back, actually just testing this 20-day moving average. So I'm not too concerned at this point with healthcare. Although on a relative basis, you can see since the huge move up back in April, March and April, I'd say over the last 3 months, it's definitely been an underperformer, especially when you look at, say, what technology's been doing or communication services or discretionary. But if you go back off of the bottom, I think the stock, this part of the market has held up pretty well. All right, let's move on. 10-year Treasury yield. We do have, or we have a couple of economic reports coming out later this morning. 9:45 this morning, so that's in about 30 minutes. We've got July PMI Manufacturing Index. Last month in June, it was 49.8. We're looking for 51.3, crossing back above that key 50 level. 50 kind of is where you got growth versus contraction. Below 50 is contraction, above 50 is growth. So it looks like the PMI Manufacturing Index, the market is expecting it to turn back up above 50, which is bullish. The July ISM Manufacturing Index comes out at 10 a.m. June was 52.6. It's looking to rise. We're looking for a rise back to 53.5. So good news. We're looking for better news in both of those manufacturing index numbers. Also at 10 o'clock, June construction spending comes out. May was down 2.1%. We're looking for June to be up 1.3%. And yes, most of these construction numbers are kind of in our rearview mirror. If you want to know what's going on with home construction, look at the home building chart, the home construction chart. That's $DJUSHB. So if we pull that up, you're going to have a much better idea of what the market thinks of home builders, and check that out. Continuing to move higher, breaking the new highs, and now challenging the February highs. I think we're going to get a breakout. I mean, if the overall market is correct and we get by this coronavirus and we've got a strengthening economy, we've got historically low interest rates. I mean, this is nirvana for home construction. So when you look at the relative strength of home construction versus the S&P 500, let me pull that up here. We'll go back a few years here. I'm going to give you a line chart. And let's go back 3 years. So here was that big drop with the coronavirus, but look at this. We have come straight back up, and on a relative basis, we've made that breakout above where we were in early March. So it's been a very strong past 4 or 5 months in home building stocks. All right, let's keep moving on. Let's go to the FANG stocks. I figure this would be a good time to take a look at the FANG stocks, given that they came out with their earnings on Thursday, and we now have 24 hours of market action to digest after that. Looking at Facebook, big gap up after its earnings report, did pull back a little bit to where the breakout occurred around 250, but then strengthened into the close. And if we pull up 10-minute, 5-day, 10-minute chart, you can see Facebook for the most part was sideways throughout the day. It did come up just a little bit in the very end of the session. Now, I had mentioned the market rallied big time the last 2 hours. You can see that by looking at the S&P 500 on this chart. And when I looked at this chart, one thing I really liked is that the last 3 days, even though we've been in this consolidation, I mean, if we pull up a daily chart, we'll come back to this in a second. But if you pull up a daily chart, you'll see over the last 2 weeks, see how we're going sideways? But under the surface of all that, we saw buying all day last Wednesday. And after early selling on Thursday that took us down considerably, we saw buying for the most part rest of the day, got the gap up with earnings, sold off, and then end of the day came right back again. So what I'm seeing is a lot more buying after we get past the early morning hours or into the early afternoon. And that's what you want to see. If I've got my choice of weakness in the morning and strength in the afternoon, or strength in the morning and weakness in the afternoon, I'm going to take the former every time. I want that strength in the afternoon. I like to see the market closing high. So I love what the market did on Friday. It looked like, okay, news is out. We anticipated great numbers. We got great numbers. Now here comes the sell-off. Well, not so fast, because the last 2-3 hours on Friday, we saw a lot of buyers. And look at the volume picking up throughout the afternoon. A lot of buyers. There's still a lot of folks that are rotating into the stock market. All right. So let's take a look at some of those other stocks. So we had Facebook. There's Facebook. So how about Amazon? Amazon tried to gap up, make the breakout. Didn't quite make it. We wanted to get a confirmed close over 32.51. You can see 32.51 was the open back on July 13th, and that's where we had the sell-off. We did get up to 32.44 on the open, which was 7 points below. Couldn't get above, we only went up for a couple of points and then sold off most of the day. And Amazon did not see the buying and kind of like Facebook, didn't really see the big buying at the end of the day, but it had a huge open. So you got market makers on the short side. You got to be careful about what you read into it after the market opened. I think this clearly was very bullish to have this kind of a gap up. All right, how about Apple? I don't know what to say about Apple. Apple is just a monster. It's part of our model portfolio. It's part of our income portfolio. It's the only stock we have in 2 portfolios this quarter, and for good reason. I mean, it's just, it might be in 2 again next quarter, which, by the way, is now that we're into August, that's only 16 days away. It's hard to believe. 2 weeks from Wednesday will be our top 10 stock selection webinar, and something I always look forward to. I actually spent a ton of time this weekend looking at earnings from last week. We'll be getting a new strong earnings chart list out, hopefully today, but if not today, maybe tomorrow might be a little bit more practical. There are 250 new companies being added to the list, and taking off about 120, by the way, because a lot of these companies are going to be reporting over the next couple of weeks, so they need to come off the strong earnings, and then we'll add the new. But I have to go through and annotate the chart, so it's going to take a little bit of time. I started that whole process, but it might be tomorrow before I can finish it. Anyhow, Apple looks great, big breakout here. And when you look at this stock into the close, check this out. I mean, from 1 o'clock, even after gapping up and going sideways, it looked just like Amazon and Facebook until about 1 o'clock on Friday. And then it just took off, even after a big gap up. And the stock already with, I don't even know where the market cap is now, but it's got to be getting close to 2 trillion. And a lot of folks thought when we hit 1 trillion, that's it. I mean, how can a company be worth more than $1 trillion? Well, Apple's now worth close to 2 trillion. And with a lot of buying coming in. I mean, look at the volume coming in. When you got a stock that's $400 and it's trading, 4 million shares every 10 minutes, that's a lot of money coming into Apple. And you got to be careful, because I've heard people say, well, Apple, the volume isn't what it used to be. It's not being supported like it used to be. And if you look at this chart, look at this 15-year chart. We keep going up, and look at the volume. This is a monthly chart. So look at the volume on a monthly basis compared to these other months. So somebody will look at this chart and say, the volume is so much less. It's not, this isn't good for the stock. You don't want to see a stock go up on lighter volume. Well, that's share volume. Look at the price of Apple. It's now $425. What was the price back in 2007, 2008 during all of this? It was somewhere between 15, 25 bucks. So we're talking at, even at 25 bucks, we're going to say that's, 17 times the price. So you got to multiply the volume by 17 to come back to look at this. That's one thing I'd love to see changed. And one of the suggestions I've made, I'd like to see dollar volume on the chart, because I think when you look at a stock like Apple long term, I think dollar volume is really important, more than just share volume. And for that reason, because it really, if you just looked at this and weren't thinking about the mechanics of it, you would just say, wow, yeah, Apple's going up, but nobody's buying it anymore. Trust me, plenty of people are still buying it. That's not a problem. All right, so that's Apple. So Apple still looks great. What about Netflix? Netflix didn't report. It's the only one of the FANG that's already reported. Netflix is fine. It was trading, very strongly heading into earnings. I think some of the numbers still look good as far as the subscribers and so forth, but they had a little hiccup in terms of their earnings, and as a result, stocks pulled back. But I don't think this stock's dead by any means. I think this uptrend is alive and well, and I actually think Netflix on this pullback is very viable. Next up is Google. This is the one that I was a little concerned with going into earnings, and I'll show you why. On a relative chart, look at Google relative to internet stocks. That's for 5 months heading into earnings. That's not just a couple weeks. And then after earnings, it actually broke to a new 52-week low. So I think Google is fine, but it's not one of the leaders, and I want to invest in the leaders. So if I'm in Google for the long term, I don't know that I would trade out of it. But short term, I think that there are plenty of better trades out there right now than Google. And I think any of the other FANG stocks look better to me than Google. All right, let's talk a little bit about breakouts. So one of the things I like to do, and I do this at least, probably once a week, maybe once every couple of weeks, but I try to go through and look at what's going on in terms of the relative strength of various industry groups. And as I went through technology, of course, here was that bounce in semiconductors. Every time we get close to that rising 20-week relative EMA, we bounce. And that's what we're doing right now. So any stocks breaking out in the semiconductor group would be of interest to me. Same goes for software. Very strong group starting to turn back up on a relative basis. Computer hardware already breaking out. And of course, Apple really helped on Friday. But we're already seeing very, very strong action there. But the other areas in technology, you can kind of see these downtrends. This is, not all technology companies are created equal. And then we get into consumer discretionary. And I've gone through these. Now, obviously, you've got Hotels rolling back over again, not good. But when I looked at, let's see, when I looked at specialty retailers, for instance, kind of pulled back, starting to turn back up, very strong group. So that's a group I was in favor of. I talked about home construction. Look at home construction on that relative basis, breaking out. How about broadline retail? Broadline retail, very strong, had pulled back, now starting to turn back up again. So these were 6 areas, and I could probably pull up in the communications services group. Let's look at internet. Even though I know Google had a little bit of a downward impact, but then Facebook was strong and kind of offset that. But here was the move up. We pulled back for, I don't know, a week or two, and now we're starting to turn up again. Very strong group. So what I ended up doing is I took those 7 groups that I just showed you that are showing really good relative strength, and I ran a scan, and this is it. So you can come back and check this out at some point. But this is, if I'm looking for specific areas, one way to do this is to use the and or clause, especially the or clause, because what I wanted to do was to run my 52-week high scan, but I wanted to run it against these groups I just mentioned. So which stocks within these 7 industry groups are breaking out the 52-week highs? So I've got semiconductors, computer hardware, software, internet, broadline retail, specialty retail, and home construction. There they are. Now, the way you write this is you just add each one of these industry groups from down here, find them, you add them. They will automatically come up as and. So I had to go up here and physically change these from and to or, and then I had to insert this bracket right here because you're including, and then I had to add another one here because it won't be there. So you have to go in and add that as well. But once you say, give me 52-week highs and any stock within any of these groups. So that's why you have to use the or clause, and that's why you have to have the 2 brackets before and after. Okay. So I've got to kind of get used to using stock chart scan engine, but it's really powerful once you do. So I looked at this, I hit check syntax. It says, all right, syntax is good. Go through, and here we have 52 stocks that on Friday set a new 52-week high. Of course, there's Apple. There's a lot of different ways you can do this, but I like to sort by scooter. Most of these stocks with really high scooter scores are going to be stocks that have been going up day after day after day, many of them. So you got a stock like this. Many of these, by the way, are also stocks that are heavily shorted. So WTRH is on our short squeeze chart list. I believe Overstock is as well, not positive. But anytime you get a stock that's on a short squeeze chart list and you have a scooter of 99, there's a really good chance that shorts are being squeezed in a major way, and that's the case there. But one of the things I like to do is maybe go down and look at some of these have lower scooter scores that are maybe just making breakouts. So when you pull these up, because their scooter score is low, they haven't been faring quite as well as some of the other stocks. So without even looking, I'm thinking, okay, they probably have been consolidating. So I pull up Fair Isaac and look at what's been going on the last 2 months. Sideways consolidation off of an uptrend. Just now starting to look to break out here above this 440 level. So you're getting something that might just be starting to run. That's the difference. Go to ANSS. Well, mostly sideways the last few weeks, but just breaking out. Volume's a little suspect down there, I saw though. Let's go up here, a couple semis. Let's look at these semis. POWI. I mean, this stock on Friday, it was at a 52-week high, went down, tested its moving averages, and then came back up. I actually like that. I wouldn't be surprised to see maybe another rise to the upside. I would watch 115 to the downside. I think as long as that holds, I like the stock. But to the upside, I think this one could make a run. Again, 2 months ago, the stock was trading around 117, 120, and here we are, still at that level. So we got the 52-week high, but we haven't been going up day after day after day. And then another one, this one reported earnings on Thursday after the bell. This was MKS Instruments, MKSI. Nice gap up with earnings. This one too just recently took out that February high in a nice little uptrend. So 20-day test, I think, would be very strong there. But that, I just want to give you an idea how you can find some breakouts in strong areas using the scan engine. So let the scan engine do a lot of work for you. All right, a couple more things. Earnings spotlight. We did just have a couple of companies reporting earlier this morning. One was Global Payments. Global Payments, let's get an update because we'll see what the market is doing with it. Gapping up, but they had a nice little beat. Came in at $1.31. Market was looking for $1.14. Stock up 1.7% here in early action. I think you got really good support now, 160, resistance up at 190. So I think this has got a chance to run to 190. The problem is you got $10, $9 to the upside, and potentially maybe $20 to the downside. So the problem with this stock is not that I don't like it. It's just that what do you do if you get in at 181 and it goes back down and consolidates back to 160? Now you're down more than 10%. If I were to get in at this position or at this price, I would absolutely be thinking about adding on weakness. So I would not be taking a full position. I just don't think the setup is right for that. Race, this is Ferrari. The stock pretty flat, not a whole lot going on in terms of volume. They actually missed, coming in at 4 cents versus 6 cents. I was surprised when I looked at this in pre-market that it wasn't selling off more, but pretty much just flat so far. Clorox had a really good report, blew away numbers, and you can see buy on rumor, sell on news. That's what's going on here. I would not hold it against the stock that it's down $8 right now. $2.41 versus $2 was their earnings. And, maybe we test the 20, maybe we can go all the way down to 50, but I actually would be a buyer on weakness on the stock. MCK, this is McKesson, up a little bit after posting great earnings, 277 versus 235. Stock is trying to break out, needs to get through this 157, 158 area. If it does, nice uptrend, left shoulder, neckline, head, neckline, right shoulder. Breakout above 158 would measure up another $18 to about 176. Let's see, Ligand Pharmaceuticals. I'm bringing this one up because I believe this one is also on the short squeeze chart list, I believe. So I wanted to see if we'd get a breakout with earnings. We did gap up a little bit with our earnings. They came in better than expected, $1 versus 65 cents, but the stock is down. I actually maybe would be looking at support because we couldn't get a breakout with earnings. I think we might see a trip back down to 105, 110, and that's where I'd like to see price action hold. After the bell tonight, we got KLA coming up, big semiconductor equipment manufacturer. Ring Central. Ring Central is one that could deliver some big numbers. Stock's been rising again heading into earnings. You can see the relative strength starting to turn back up again. This has been a strong company that for the last 2.5 months hasn't really gone anywhere. Starting to strengthen into earnings. I don't know. This is going to be a very interesting earnings report after the close today. Take-Two Interactive, been very strong. I expect a strong number coming out there. CHGG. By the way, this is the first stock that's on our strong earnings chart list. If you own stocks on the strong earnings chart list, check earnings dates. Like I said, I'm in the process of updating this earnings list, and I'm going to be getting rid of a lot of companies at the beginning of the chart list that will be reporting earnings like CHGG. So just be careful if you've got stocks you've been holding for a while. Make sure you check the earnings dates, and I'll try to get that updated as soon as possible. But the stock breaking out looks good, heading into its earnings report. Solar Edge, SEDG, renewable energy that recently broke out, heading into earnings. You can see it's one of the leaders in the renewable energy space. FIVM, software company, breaking out as it heads into its earnings report. Another one, and then this one could have fireworks. Virgin Galactic, SPCE, one of the most heavily shorted stocks out there. It's actually broken out recently. What's going to happen with earnings? I don't know. If the earnings are good, we can see an explosion. But there's a reason why folks short a stock like this, and maybe they're right. We'll just have to see with earnings. I don't know. Holding a short squeeze candidate into earnings, really, it could go either way. It's a coin toss. You could make a fortune, or you could get hit really hard. I think these are riskier heading into earnings than any. If I owned one and I was up heading into an earnings report, I think I'd have to at least sell part of it, at least half of it probably, just to make sure I lock in some of the gains. Yes, you know, if you gap up after earnings, you're going to be kicking yourself. You didn't hold the whole thing, but that's a little bit of greed. And you want to make sure you're not overly greedy in the market. All right, what else we got? Let's move on into the three you must see. Tesla. A couple weeks ago when I went through the earnings and I told folks, here are my top 5 companies heading into earnings. Well, they've all reported now. They've all reported better than expected revenues and earnings. Tesla was my number 1 company. Now, look at this company. It was already in a huge uptrend, reported earnings, gapped up, but it has been selling off since. I think it may still have more room to the downside. I wrote about this not too long ago. Tesla, if it doesn't hold on to the 1350 area, I think Tesla could go down, test the 50-day moving average. Does that mean I don't like Tesla? No, it means I love Tesla if it hits 50-day moving average, because I love Tesla going forward. I think it's one of my favorite stocks, but the stock made a huge run. You know, you buy it at 1,700 and it goes down to 1,200. You think it's the worst stock ever. If you buy it at 300 and you're at 1,400 or 1,200 or whatever, obviously it's been a great stock. So it's all relative and it's all based on perspective. But this is a company that's growing rapidly and pullbacks, I think, should be accumulated. Next up, I already mentioned Amazon, but Amazon was the number 2 company, I said, in terms of just confidence about their earnings, not necessarily reaction to earnings, but whether they were going to post solid numbers. I was pretty confident Amazon would. They blew the numbers out of the water. I mean, it wasn't even close. But the stock's selling off a little bit after posting its strong results. And then the third one I posted was Dexcom. Dexcom also had a pretty muted reaction, but huge move up. I think we're in a nice, right now, equal highs, rising lows. I see an ascending triangle in the short term. I think we're going to get a breakout and make a run for 500 on DXCM. All right, that is it. I do want to say the other 2 stocks that I mentioned as my top 5. One was eBay and the other was Shopify. And if you've seen the numbers there, they've been strong. Shopify was massive. I think Shopify, they were expecting a penny profit. They came in, I think it was $1.05. I mean, they just blew the numbers right out of the water. All right, that is it for today. Let's go ahead and just get a quick update. Probably selling off a little bit after they open, it seems like. No, not really. NASDAQ still up 100. Dow up 119, S&P up 15. So on a relative basis, once again, we're seeing leadership in the NASDAQ. S&P 500 percentage up. Varian is up. Microsoft having a really good day. Qualcomm, Apple, there it is again. Apple up another 13 today. Wow. Just a huge, huge move. And by the way, I've been talking about railroads. Look at one of the leaders, Kansas City Southern. Look at the day it had on Friday right there. Huge, huge move up on heavy volume. Continuing to move up. I think it was upgraded this morning, but stock looks pretty good. Anyhow, let's go ahead and wrap this up. Everybody have a great day. And like I said, for our members, we'll be trying to get that updated strong earnings chart list and the strong future earnings chart list. Try to have both of those out to you here in the next day or 2. All right, everybody have a great day. Talk later. And I'll be over at the Stock Charts TV for your next episode of Trading Places Live tomorrow morning, 9 a.m. Eastern. See you then. Happy trading.